We are live.
Okay, hi Saurabh, thanks for joining, and big hello to both Marcellus and Cherry viewers. I think very few people require as less an introduction as Saurabh does. Saurabh I know for a while, so I'm also had the good fortune of calling him a friend. But for most people, he is one of the best known faces in the area of portfolio management. Currently founder and the brain behind the firm Marcellus, and a lot of people will associate Saurabh with many philosophies, including the original coin term coffee can. So I think we are joined by Saurabh, what promises to be a fairly engaging session. So welcome, Saurabh.
Thank you very much, Srikanth. Thank you. Pleasure being here. Looking forward to this.
Right. So Saurabh, let me dive straight in. I know everyone's keen to hear your views. While we've got certain things in mind, but let me kick off by just taking your quick take. I think it's an interesting time that we are having this conversation. There are a few important events that we have left behind us. There are both the US and Indian monetary policies, which has recently happened. The union budget has recently been presented, and of course, a couple of large market-making events have also happened. So let me just throw an open question at you and ask you to maybe enlighten all of us in terms of how you read the current context of the market, Saurabh.
So look, Srikanth, I'm not a big fan of sort of macro stuff, right? This whole nonsense around GDP growth forecasting and FX and so on. But I suppose partly because of our sort of inclination in Marcellus to read endless amounts of books, one of the things we end up doing, even without wanting to, is understanding sort of the structural changes in our society and our country. And if I look around the world, if I look around at our client base, look at the growing international interest amongst institutions abroad to invest in India, I think there are two very positive things happening. And I think there's one worrying thing happening, right? So let's focus on the two positives first, and then I'll come to the one worrying aspect. I think the biggest positive I can see in the last 3, 4, 5, 6 years is both tangibly from living in India, and from speaking to my friends, relatives, and clients abroad. It is clear that India has materially improved as an economy. Right? I'm not going to comment on social changes here, not the forum for it, but it is evident that as a well-functioning free market economy, we have made several strides forward. So, for example, if I look at the cost of capital in India, right, 20 years ago, the 10-year bond yield was 13%. Today, it's 7%. If I look at even the last 12 months, the US risk-free rate is up 4%. Our risk-free rate is up 2.5%, right? So there are many such elements of this. For example, also the rise of UPI, right? From nothing 3 years ago to now 52% of GDP going through UPI, and sort of hordes of foreigners coming to India to understand UPI. In fact, you'll be amused to hear, Srikanth, that one of the things that FIIs, when they come to our office, they want to see is the coffee shop outside Marcellus. Because I've written in my blogs that this young lad from Telangana, he doesn't take cash, he only takes UPI. So the FIIs pose with this young 22-year-old lad, jiska sign bolta hai ki, don't pay cash, please use UPI, right? So that's I think the first thing to be happy about, proud about. The economy, as a functioning economy, I think we made significant strides forward. For those who are listening and you want to invest in India, build a career in India, I think that's a good thing. In the second area where we've clearly made a tangible stride forward, something which is very relevant for your business and mine, is we are clearly financializing savings. So when I came to India in 2008, for the first 6-7 years, whoever I used to speak to would say, "Maine yahan flat le liya hai, wahan flat le liya hai." Some people I used to meet, they used to buy 2 or 3 flats in one go, right? And I could never understand this because I never understood real estate as being a particularly big wealth creator. There's no rational reason why real estate will be a big wealth creator, right? In the last 5-6 years, both the growth of your franchise, the growth of our franchise, anecdotals, house price sluggishness suggests that Indians are financializing wealth at a rapid rate. So, for example, demat accounts, I think they were 15 million 10 years ago, they're now 120 million, right? Similarly, the PMS industry in 2008 was all of 10,000 crores. Today it's 3 lakh crores, right? As we financialize wealth, for the average Indian middle class family, their ability to capture GDP growth becomes far greater. My father's generation, your parents' generation, they worked very hard. Our parents worked very hard, but by doing FDs and buying flats and buying gold, they were not able to capture the benefits of economic growth. Right? The good news is many of your clients are actually capturing the benefit, and that's a hugely powerful thing. The one negative thing that we are seeing, right, and it worries me, I don't have an answer as to how this will work out, is as the country becomes more modern, as cost of capital falls and businesses become more and more automated, the need for class 10 pass people, or even class 10, if you're not class 10 pass, I don't know what you'll do in India, but even if you're class 10 pass, it's not evident to me that Kotak Bank, HDFC Bank, TCS, Marcellus, etc. will give you jobs, because everything is getting automated, right? So to take a case in point, if you take, say, a company that we've invested in, HDFC Bank, the profits are up 8 or 9-fold in 10 years. Employment has just about doubled, right? And I'm seeing this trend across the country. Even factories that I visit, there's hardly any labor, it's all machines and robots. And alongside this, I'm not yet seeing the policy intervention or the political intervention to say, let's go on a war footing to upskill people. To be fair to the politician, even if you upskill people, it's not evident to me that tomorrow morning Maruti or TVS Motors is going to hire a lot of people, because increasingly the nature of modern economic life is machines, robots, AI, automation. And for a country like ours with 500 million labor force, median age 28, what that means, I don't have an easy answer to that.
No, in fact, fair point. Just for everyone's benefit, I think the first example that Saurabh gave on UPI, the recently concluded MPC has now, as a pilot, also invited UPI for inbound travelers coming into India. So I think it's a beautiful thing to showcase, as a tech stack of UPI from India is actually, even when we speak to developed world, something to the power of UPI still doesn't exist anywhere. I think that's one thing that India does deserve to showcase. And also on the last point that Saurabh mentioned, I think it's been enough said and sort of articulated it well, but I agree that the demographics that we have could either be a boon or a bane, depending on how we channelize it, because it's a given that the way 4G and now hopefully 5G has penetrated in India, the way we've got a reasonable claim on soft power in terms of information technology, on one end should hold us in good ground. But if the whole thing is not channelized in terms of the right upskilling and right education, it can completely go on the other side. So absolutely pertinent, Saurabh. So let me take that, and I also agree that you're always someone who's more bottom up. You look at things in far more detail. You help pick companies rather than just looking at macroeconomics. So from that point of view, you very famously sort of introduced the Indian version of buy and hold in your own inimitable way. And there are examples galore of how you believe that there are certain companies where you should not get overly phased by metrics such as PEs, because the growth will take care of some of the multiples. But tell me, in a fast-changing world like this, where cycles are shortening, where technology is making interventions at speed which has never been thought through, is there any change in that philosophy? Does it mean that people have to constantly keep looking at changing cycles, or you think that philosophy is still valid even in these market conditions?
So the world is fast changing, no doubt about it. And as you referenced, and as I was saying, India's technology stack is changing even faster than I suspect, say, a typical European country or even a typical Asian country, right? The whole Aadhaar, Jan Dhan, UPI, ONDC piece is moving breathtakingly fast. I don't think even America has anything remotely like it, right? So the question then is, how should you and I as investors take this, right? Does this increase competitive intensity and therefore reduce ROCs, reduce cash flows, and therefore structurally reduce valuations? Or does it polarize the economy even more? Remember, the defining narrative of India in the last 20 years has been rapid polarization and corporate profitability. So when I came to India in 2008, the top 20 companies used to account for 30-40% of profits. Today, the top 20 companies account for 70-80% of profits, right? And over the last 20 years, the economy has gone forward, but the benefits of growth have disproportionately gone to a handful of very well-run companies. So there's a mental model I'll park with your clients, right? So the book to read on this is Robert Hackstrom's The Warren Buffett Portfolio, and he makes a lovely point there that Over the last 20 years, as technology has improved, fund managers have generally become better. They've gone and got themselves educated, MBAs, CFAs. Everybody has spreadsheets. Everybody has Bloomberg. We have all the data in the world. You're trained to invest better. So the average fund manager today versus the average fund manager 20 years ago is clearly better, and competitive intensity in fund management has gone up. But paradoxically, because the industry has expanded and it's a highly competitive industry, disproportionately the top one or two fund managers take away the spoils, right? Similarly, say IPL and cricket. The average cricketer in India, if you watch Ranji cricket, it's no question about it. The average cricketer in India is far better than it was 10 years ago. But the rewards have got polarized even more. A Virat Kohli or a Rohit Sharma pulls away many more multiples of the average Ranji cricketer's salary than was the case 20 years ago. So now let's come back to the economy and apply this. I think something very similar is going to happen in Indian economic life, right? Generally, as the economy becomes more transparent, pan-India, greater use of technology, general productivity levels are up. For example, in a typical Marcellus investee company, the working capital cycle I can see has reduced from 90 days to 70 days, right? So that's the good news, that generally we will get better. But as the size of the pie expands, as there is more to play for, as the informal economy dies, the spoils will disproportionately grow to one or two players. So say in the context of, let's take adhesives, right? There will be other challenges to Pidilite, no question. The challenges to Pidilite and adhesives will do a better job than they did over the last 10 years. But as the adhesive industry expands, as more people build homes, they might get better furniture, the addressable market for Pidilite expands. And very similar to Novak Djokovic and Nadal pulling away all the prize money on the ATP tour, or Virat Kohli and Rohit Sharma pulling away all the spoils will disproportionately go to potentially a Pidilite, right? And I think this dual narrative is worth understanding. The general level of economic efficiency will go up. Generally, I think ROCs in India will improve, right? But as the market expands, as the economy expands, the top one or two guys take away even more than we've hitherto been accustomed to seeing. And you're seeing there's lots of data to show that's exactly what's happening. If I could sit here and give you data all day on adhesives, pipes, jewelry, paints, to show you that this polarization is becoming sharper and sharper.
Actually, so that's very interesting. Would you then sort of also go on to say that one of the reasons that has plagued at least people in my fraternity as managing investor monies, at least in the last 3-4 years, it's been almost very difficult to beat Nifty as a benchmark in India or index at a broader level. One reason that we usually attribute is there is disproportionate passive money that flows into some of these indices from foreigners, but would also something that you mentioned, that in a broader sense that the big gets bigger in an environment like this, means that the companies that are anyways from part of what we call as index or Nifty in India's case, is that also the reason that of late it's almost becoming more and more difficult in India to beat Nifty?
So I haven't seen data that suggests either in mutual fund or in PMS. It's got incrementally harder in the last, say, 5 years. I agree with you, say today versus 20 years ago, it's clearly got harder, right? The Indian market is more competitive today versus 20 years ago, but I'm not so sure today versus 5 years ago it's changed. Where I think there's a little bit of a mental analytical flaw, and I'm just as guilty of this most of the time, is if you narrow the time window, right? If you narrow the time window, you pick up more noise than skill. And therefore, in say a time window of 1 year, the typical newspaper headline that I've been reading for 10 years is 90% of equity mutual funds underperform in the last 1 year. 80% of PMS is underperform, right? So that's a kind of perennial newspaper story, right? But if you increase the window to 3 years or 5 years, you'll see it's relatively clear where the skill is and and who are the skillful fund managers. So let me give a straightforward example. Berkshire Hathaway has been publishing annual reports, at least I can see them for the last 50 years on their website. And I can see their share price performance as well. So 50 years means 12 times 50, 600 months you got data on Berkshire Hathaway. If you were to look at how many months has Berkshire Hathaway beaten the S&P 500, right? You'd find that 50% of the months they've underperformed the S&P 500. So you'll be tempted to say, "Ki boss, Charlie Munger, Warren Buffett overhyped. Yaar. Kya aata hai unko?" Half the time they're underperforming, coin toss, right? If you stretch the window to 3 years, you'll see that they outperform 60 or 70% over 3-year rolling windows, right? If you stretch the window to 5 years, you see that I think more like 80% of 5-year windows, they outperform, right? And that's remarkable. Look, if you, on a month by month basis, aadha mahina, 50% of months they're behind the market. But on a 5-year basis, they are killing it 80-90% of the time, right? I think similarly in Indian investment management, but for reasons I don't fully understand, the wealth management community doesn't quite do this. They don't do the 5-year rules. Part of it is they say people like us haven't been around for 5 years. So you can rightfully say, how will I do it? I don't have data on you for 5 years. But as I think our investment community settles down and it becomes evident by looking at 1-year returns, kuch zyada milne nahi wala, and the longer time frame is considered, you'll start seeing a skill emerge. I think as is the case, as I was saying, in any competitive sport, or tennis ho, cricket ho, fund management ho, naturally only 1, perhaps even 0.5% of fund managers will be able to show skill, and they will do the Virat Kohli Djokovic thing, which is they scoop the gains disproportionately.
No, so actually, sort of that point is absolutely right. In fact, there's one thing that through this medium, even I would want to sort of pass on a message is, I think there's one cliche which just refuses to be irrelevant in any market condition is, if you hold quality, just hold it for a very long period of time. And I think this guilty pleasure of having short-term outperformances or underperformances, which I think, including me, many of us should also be partly guilty of, is something that we should avoid as a temptation. Wealth management, portfolio management in any capacity, either as an intermediary or as the end portfolio manager, is a responsible activity. And I think for the end user through this medium, I'll communicate that avoid the temptation of frequently changing, especially if the quality is good. But so that's another thing that I think investors can gain a lot from you, that if broadly, it's very commonsensical what you're saying, and I don't think anyone will want to disagree with it. But at what point do you say that, okay, despite all things being equal, despite we being patient with a particular quality stock, there are still times when you need to make a hard call exit. There are still times you should say, is it only if there is a broad change in the model or philosophy? Or when is the time when you sort of say that, okay, I gave it a go, but now is the time for me to wind up my position and I think I'll get out?
So I think there are 3 clear such times, right? At least the way we have thought about investing, Marcellus, there are 3 junctures. First is theft, right? So if you spot theft, there is a possibility that you have mistakenly spotted theft. So typically we sit down with the promoter and say, we think you're stealing money here. This is the theft. This is you've created a related party. Say your cousin, you're buying raw materials from your cousin, you're over invoicing the listed entity and stealing the listed entity's money through related party transactions, right? Typically, remember, these are not going to be de jure related party. And if it was de jure related party, the whole world would know. So it'll be typically the promoter's, wife's brother or something like that, right? So you'll have to sit down and have a chat, and he might say, yes, I'm doing it. It's my wish in life. You guys take a hike, in which case we have to go and sell the stock. The second is that he's not a crook, but he's made a business misjudgment, right? Now, if it's one business misjudgment, we're all human beings, right? So usne price hike le liya hai. He's done a price hike. He shouldn't have done it. He realizes that he's screwed up, and you have to realize he's a human being. We all err, I err, and you have to say, let's give him the benefit of the doubt. But if you keep seeing a pattern of business misjudgment where, say, the promoter does not bring in top quality talent from the market, the promoter himself is not able to bring in groom talent, and he keeps erring on judgment calls around pricing, around product strategy, around capital allocation, then you have to say, yes, there is a moat, but hey, the behind the moat is a faltering king, a king who's losing his way, and we definitely need to check out. So that's the second area where the king is basically losing his skill. And the third area is the moat itself gets blown up, right? And I'll give an example. I think the blame for this should go to me rather than anybody else. right? So because I read perhaps too many books for my own good. I remember reading that Warren Buffett had made a lot of money on Capital Cities ABC in America, right? So that's a radio. So a guy called Tom Murphy was a Warren Buffett friend. He basically bought lots of radio stations, put them in one company, made them more efficient, and created a giant company called Capital Cities ABC. So, in our infinite wisdom, but I also have to say, particularly in my infinite wisdom, I thought, ये तो India में भी होगा, right? We will also consolidate radio companies, and we ended up buying Radio City, right? I think they had a good management team. Apura Purohit, I think, was doing a wonderful job. She'd taken the company public, used to be private equity owned. She'd taken it public. She'd done a good job of running Radio City. I used to listen to it in my car. But I did clock that I had stopped listening to Radio City in my car, and I was now listening to music free on YouTube in my car journeys. And I should have clocked that nobody now listens to radio music. They listen either to MP3 or Spotify, or they listen to YouTube में free गाना. And because we didn't spot it, we held on to Radio City perhaps longer than we should have. And that was an example of the moat completely being blown apart by disruption, right? So corruption, incompetence, disruption, this is what keeps us awake at night. And this is what leads to the 10-15% churn that you see in our portfolios.
So one asset class sort of that you in your book mentioned as a dangerous asset class, and I'm very conscious of the fact that I didn't want to link it to the previous statement, but I think it's a good time for me to bring that question is real estate. And, and let me push you further on this, because is the grouse against real estate as an asset class, or is it more contextual to India that you make that comment? And I think it's something that is there in a lot of people's mind. You also spoke of financialization in your first answer. Do you think you've changed your mind on that? Do you still hold that sector is a bit of a dangerous asset class? What's your take on that?
So look, I think buying your own house to live in, right? That's a perfectly forgivable sin. I'm guilty of it. I could blame it on my better half, saying, she wanted it, but I think I wanted to live in my own house as much as she did. And, I live in a nice part of Bombay, zero capital appreciation in 8 years. Now, you might say it's an aberration. So I'll give you my dad's story, right? This is a hardworking, engineer, IIT engineer. My mom was a math teacher. I remember I was 6 years old, 1982. We went to take a HDFC home loan. And my dad and his IIT friends built a cooperative housing society. It took them 10 years to put the structure up, by which time it migrated to the UK. That part of Delhi, place called Mayur Vihar, boomed, right? Absolutely boomed, right? If you go there, it's unrecognizable to the Mayur Vihar I saw in 1982. The metro is going past their house. But 7-8 years ago, I started telling my dad that if you go to Delhi, it's a sea of flats, and the sea of flats keeps getting, I think, expanding. I think one day Delhi will expand into Pakistan. I don't know what they'll do then, right? So I kept telling my dad that, look, I mean, how will you get any capital appreciation on the asset? It just keeps rolling out and out and out, right? So when we had built it, it was the Mayur Vihar in the 80s was the edges of Delhi, but now Delhi or NCR stretches a good 60 kilometers north of it. So I said, you'll never get any capital appreciation because the supply keeps coming on and on and on. But he and I kept arguing about it, as bongs do, right? Very intellectual debate on housing. So finally, HDFC sold itself to HDFC Bank last year. So I used that as a trigger, and I called my dad and said, look, even the people who gave you the home loan, they've sold the company as well, right? So he said, chalo, theek hai, sell it and put it in Marcellus. So I went to sell it in Delhi, right? And I had high hopes on the flight. I was doing my maths, kitna milega. I knew a few brokers in Delhi. You won't believe it, Srikanth. Flat purchase in 82 in one of the most prosperous areas of Delhi with the metro going past it. In spite of my selling skills, all I got was a 6% gross CAGR for my father. 6% gross CAGR. Right? I mean, after paying the tax, which we'll pay now, 5% net CAGR aega. Right? During my parents' life, inflation, had they lived in India, inflation would have been the same number. Which means people like my parents, and I suspect the vast majority of people who are listening to this, you get zero real return. After inflation, if real estate and gold and fixed deposits and insurance policies are your main investment, after inflation, you're making no money at all, right? And it gets really tough. It gets really tough to have a good life, a good retirement. if the core of your wealth is really not compounding at a decent rate. Now, I don't know about clever asset classes beyond equities. Unfortunately, my knowledge is limited to equities. The only asset class I can see for my socioeconomic strata, for my friends, my relatives, and my clients is invest in good quality Indian stocks and avoid the fate of my parents, which is zero real returns over a life of 40 years of very hard work, first in India and then in the UK.
No, true. In fact, it's something that I often quote that India, if not the only, but is one of the very few countries where a 100 rupee house, for example, if you take a mortgage on that, depending on at what stage did you take a mortgage, your cost of loan will be anywhere between 7 to 8%. Your residential yield is anywhere between 1 to 2.5% at best. Now, I have not seen this any part of the world where your residential yield is at least 500 basis points lower than your mortgage. Any asset class, even if you are not as sophisticated or initiated as Saurabh is or as some of our other investors are, even a simple fixed deposit, of course, capital gain, Saurabh just sort of busted some of the myths, is another story. But on simple yield that you get, it beats the hell out of me. But I think it's the demand supply that keeps some of these going. One asset class.
Just on that, just to finish up on that, it's not as if I've got a mental block against this, right? I'm a businessman as much as anybody else. So my brother-in-law in the UK, right? He has a good job. He earns a lot of money in his job. But in the UK, the maths is ulta. UK, you can borrow money. I think he borrows at 4.5, right? And he gets a yield of 5.5, 6. So as it is, he's earning good money in his day job. And over time, he's built a portfolio of 5 or 6 houses in various parts of London and south of England, where he's paying good 100, 150 bips less. The yield itself is comfortably paying for interest rates. And his point is, why shouldn't I do more of it? And I can't disagree. He should do more of it. If India was like that, I would also consider building a portfolio. But India isn't like that. India is like Srikanth is explaining, 2% yield, 8% home loan. You've got to be out of your mind to be buying property as a business. If you want to live in it, that's fine, but don't do it as an investment.
Yeah, no, I completely agree, sir. My point wasn't to make a binary point that an asset class is good or bad, but I think investors should remove information arbitrage as much as they can, remove the overall emotional quotient from an intellectual quotient. Of course, everyone requires one captive house to stay in, but when you buy real estate from purposes of investment, it's important for one to sort of sit down, do the maths, add the transaction costs, add the yield, and then sort of make a call. Though one asset class I must give in, and something that we also sort of have hosted on our platform in Cherry, is the listed REITs. I think it's a beautifully structured asset class which runs to perpetuity. Good quality office spaces are built in, and in commercial real estate, for the benefit of everyone on the call, the maths is very different than what the maths in residential is. More or less, the lease rental discounting rates and the commercial rental yields, even if they are not at par, they are not with a 500, 600 negative delta between the two. And with REITs coming in and being available to every investor for as low as 300 rupees, which is one REIT is equal to the face value of the REIT itself, it's a beautifully democratized and fractionalized product which people can hold with cash flow coming in for a long period. Of course, this is for investors who are looking at diversifying their risk profile from mainstream asset classes like equity and fixed income. So one could sort of, with slightly more information built into it, can look into it. Sort of one more thing I'll ask you, and then I had a few questions on specific to some of the Marcellus offering. But before that, so I think there's one thing that at least it's something that I believe a lot in, and when I say I, even the institution believes a lot in, is India is still, let's say, give or take some numbers, but a 3 trillion GDP. US is almost a 22, 23 trillion. China has a 16, 17 trillion GDP. Now, most of us culturally, A, because of the fact that we had a very capital controlled regime, and B, because of the fact that because of that, we've been culturally very inward looking. The home country bias in India is almost 90, 95, 99%. Whereas in my previous roles, I also used to manage some of the international wealth franchises in New York, in London, in Hong Kong. even with countries which are 8 times GDP, 5 times GDP, per capita is at 5 times, 6 times, I would never see more than 30, 40, 50% home country bias. And this I'm talking on the higher side. Now, without getting into the mechanics, whether one should export capital via LRS or through feeder funds, what would your message be? A good diversified portfolio, should it be inward looking because India is supposed to be doing better than others, or a well-diversified portfolio should be a mix of diversifying across geographies?
I think the first thing to realize is this whole notion of Indian and foreign gradually, I think, is becoming a bit of a nonsense, right? Because I'm talking to you using a imported laptop, imported software. My phone is imported. I think my perhaps Srikanth's watch is imported, right? If you drive a car in India, half the components inside are imported, even if it's an Indian car, and so on. We invest in TCS. TCS pretty much gets 90% of its revenues from imports, even in our small cap portfolio, right? Many of the companies in our small cap portfolio, the majority of revenues come from outside India. So the notion that you and I will lock into some uniquely Indian compounding, right? Something unique to India, I think is a little impractical now. If somebody wants to do it, I mean, you can try, but I think I'll struggle to give you a stock which has no global linkages, right? So that's the first point to realize, that when you're buying a TCS or even a Garware Technical Fibers, effectively you're buying the global economy, right? Even with a small cap like Fine Organics, you're buying global demand because half of their revenues, more than half of it, comes from abroad. The second is, just as in India, promoters who are clean, good capital allocators, and build dominant franchises, build distinctive capabilities, build moats, they make a ton of money. Same logic applies in Europe or America, right? Companies which are run by clean promoters who are not crooks, companies where the promoter uses brains to allocate capital well and builds moats, distinctive capabilities, makes a lot of money. In fact, so I lived in the UK for 18 years and I left that portfolio behind in the UK, and I keep looking at it from time to time. I find something really interesting. In sterling terms or dollar terms, I compound in the, say, low teens to mid teens. If I convert it to rupees, that'll be around 17, 18, right? That's not a million miles from CCP's 6-year, our CCP product 6-year CAGR net of fees of around 19%, right? And that's certainly better than my UK portfolio's compounding is actually better than a Sensex or a Nifty compounding, right? So the point I'm driving at is a high-class Indian compounder and a high-class Western compounder broadly in rupees will give you a high teens return, right? So I'm saying like say a large cap Indian company at Titan or an Asian Paints, or a large cap Western company, Google, Microsoft, Amazon type thing, because both management talent and especially Indian management talent and capital now arbitrages globally, you'll end up, I think, with high teens returns, rupee terms may, with global or Indian plays, right? And then the final question is, kitna yahan pe, kitna wahan pe, right? And the way I have done it is, this is called the Kelly criteria, right? So you bet size basis certainty. Because I live here, right? I live here and I earn here, my certainty here is greater. Yes, I could LRS out and LRS out a little bit. But since I've left money there, I have an allocation there. So the maths I have done is, the maths I have reached is 2/3 India mein, my equity exposure. I don't have any debt exposure. I never understood the logic of buying debt. So I do 2/3 equity India, 1/3 equity outside India. And hopefully, if the regulatory permissions come through, the sorts of equity portfolios my colleagues and I have built abroad, you guys will be able to participate in that a few months hence if you get the regulatory permissions. But I think investing in Western, European, American monopolies which compound in high teens is just as compelling as investing in Indian companies which compound in high teens. And as I said, this notion of I will fly the flag through my portfolio is a little outdated. I think it's too late to fly the flag through your investment portfolio.
Right. No, I think common views that even we share on this one. So that brings me to one of the new launches that I've seen coming from the House of Marcellus, the Python code-based fund. So in general, my question is, there are a lot of quant funds. A, is this in that genre, or is it a more actively picked portfolio? And B, a little bit detailed for everyone's benefit. What's the thought behind niche category of Python code-based fund?
Sure. So look, I think for reasons that are little unfortunate, a lot of people associate quant with high frequency trading. They associate quant with long short. They associate quant with all sorts of financial jugglery around leverage, right? I'm sure there are people who are skilled at it. Unfortunately, we are not those people. We are neither good at FNO nor long short nor leverage. So our quant is incredibly simple. We basically took our books, right, the books that we have written over the last 4 years. We tried to do quant ourselves. Then we realized that coding in Python and applying a degree of machine learning to that is not child's play. And therefore, we looked in the market. And it was our good fortune that 1.5 years ago, a gentleman called Krishnan joined us. Krishnan is IIT, IIM, Goldman Sachs Asset Management, D. Shaw, followed by Morningstar. So Krishnan immediately got it. I think, given his brain, it took him, I think, all of 2 days to read our books. And he started coding. And he built a process which basically is taking the Marcellus philosophy. First thing he coded was our forensic accounting system. So we used to do it in Excel and through judgment. And he coded the whole thing in Python, 10 forensic rules slammed into Python. So in Meritor Q, the product that Krishnan runs, in Meritor Q, every December, he basically pumps into Python 3,000 annual reports. And Python tells him, here's the 40% of companies who are naughty people, screen them out. Then Krishnan says, looking at the remaining companies who are clean as per the forensic code, who are the companies with low leverage and consistently good ROC? So Python gives them a further short list, right? He then says, amongst these companies with good financials, good profitability, low leverage, who are the companies with where I can get good ROCE and I can get low price to free cash flow, right? So that becomes the Meritor Q portfolio, companies which are fundamentally strong, clean, and yet available at a sensible price on price to free cash flow. There typically tends to be around 40 such stocks. Every 6 months, Krishnan redoes the algo, rebalances the portfolio. And a lot of people had asked us that, PMS में 50 lakhs hai, हमारे पास 50 lakhs नहीं है. So Meritor Q, we said, will therefore be for the world that cannot do 50 lakhs. And Meritor Q is a 10 lakh portfolio. It's an investment advisory portfolio, which means the demat account stays with Srikanth or with Srikanth's client or his friends. Marcellus simply offers an advisory construct, the Meritor Q portfolio. If you want it, you can buy the whole thing. If you want to buy some stocks but not the others, it's up to you. Once you pay the advisory fee to us, whether you take our advice or don't take it is left up to you. Therefore, you as the investor exert a heavy degree of control. We feel happy that we've been able to give our books and our knowledge across to you through the via media of a Python coded product, which gives you a so-called quantitative product. I call it quantamental. This is fundamental analysis put in quant. The returns for this basis, the 16-year back test, look to be net of fees. The returns look to be around the 20% mark, similar to CCP. But as I said, historically with CCP, the challenge was the 50 lakh PMS ticket. With this advisory product, hopefully, we'll be able to reach out to far more people. The first 2 months have gone well. We are beating the index by a little bit. Around 160 people have signed up. $2 to $3 million is what we are looking after in advisory construct. But let's see. I don't think anybody else in India has ever done something like this. And this is our attempt to take our intellectual property and give it to a broader audience.
No, in fact, on that note, through this medium, I'll let everyone know that Cherry, for example, has already onboarded one of the baskets that Saurabh and Marcellus sort of have produced. And very soon, we will look into other offerings as well, because what Cherry does essentially is also to democratize the ability for people to invest lower sums of money if they don't want to put 50 lakhs. And the way to do that is to embrace technology. So we are very happy with the partnerships that we have forged with Marcellus. And for listeners, Python essentially is the language which is used for what you otherwise commonly would know as AI and ML. So the computer language that powers the codes being written for artificial intelligence and machine learning is Python. And Saurabh was right. I think in India, since it's the very initial days for quant fund usually gets associated with high frequency or algo trading. But for a very simple use case, anything that is rule-based, where you don't have huge human emotions sort of taking the heavy lifting, but you put some rules and the quantitative matrix sort of filters it out, that can be described as quant. So quant in itself is a very large juggernaut of genre. International markets have done much more value demystifying through quant. India, it's starting up. I would say that anything that starts, every investor who's keen to build a portfolio over a long period of time should do the heavy lifting. So, sort of one last question from my side, and then I'll sort of open it up for in case you have anything or audience. In your book, I also see that there's a very unique term you use called patience premium. I know parts of it we've covered in our discussion today, but I've always found it very interesting. So I thought since I have you, I might as well squeeze that in and ask you, what is patience premium and how should investors use that for their portfolio creation?
Well, let me use a cricket example, right? So Virat Kohli, I think, started playing international cricket 2006-07. I remember watching him very early on in Eden Gardens. And, he scored century after century, incredible run all the way roughly up to COVID hitting us, right? As COVID hit us, like rest of us, he sat at home. And I guess for an elite cricketer like him, he lost his touch. So he went through a 1.5-year period. There was a lean patch, right? And naturally, as you expect, and I've seen plenty of this in my own personal life, people said, Kohli ko drop kar do. He's lost it. And you won't believe it, ex-India cricket captain said, this guy should be benched. And I kept thinking that, I applied our framework. So I asked myself, is this guy, is he partying or is he practicing? And nothing I read in the media, I don't have any specific details on his personal life, but nothing I read in the media suggested that his fitness regime, his practice regime has relaxed and he's now going and partying late into the night. Second, I said, when I watch him play, does he look to be have got aged? Has he lost his reflexes? And again, I played cricket for school and for college a little bit. I know a little bit about the game. It didn't look to me that he was behind the curve, right? He was still against express pace. He was still playing pretty well. He was just getting out for in the 30s, 40s more than he used to. And then the last piece I did was I said, when we go to Australia, it's the difficult conditions, right? So anybody can flog the bowling to death in Rajkot, right? But when you go to Australia at the Gabba or in England at Trent Bridge on bouncy seaming tracks, do we have lots of other people in India who are going to be performing for India? And I couldn't find them. I watched cricket a reasonable amount. So I said, well, in that case, where does the question arise of dropping Kohli? You ride with him for as long as he's willing to play. If he fails one of those 3 tests, you drop him. You get either his discipline eases off. Secondly, he looks to be completely out of touch, and thirdly, better options come along. But in the absence of that, you persist with Kohli, right? And that's what I meant by being patient with a star player. Similarly, with a star stock, right? So Warren Buffett actually said long time back, the stock market is very simple. The stock market is a means via which wealth is transferred from the impatient to the patient. That's all the stock market does. People who are impatient, people who drop Virat Kohli, they transfer their wealth to people like me who hold Virat Kohli. And I'm happy to do it for the rest of my life. I love it. I like Kohli as a cricketer, and I like Kohli type stocks. I like Dravid type stocks. Consistent. They go through their phases where their performance is a little weak, but I stay with them. My colleagues at Marcellus, we stay with them. Now this is hard to do, right? I deliberately use the Virat Kohli example because lots of people can identify with it, right? So I'll give you an example. Before I started the call, I finished a call with a long-standing Marcellus client. And he was saying, boss, Asian Paints ka to growth hi nahi aaya this quarter, right? The quarter to December. So I've done a few such calls in my life. So I said, sir, 3-year CAGR for Asian Paints, revenue CAGR is around 18%, right? If you look back, sir, when the world exited the Delta wave, we went through 2 frenetic quarters of volume growth. And therefore, YOYs, the growth doesn't look great because you're losing the tailwind on volume growth that you got, the extra artificial juice up in volume growth we got in the quarter to December last year. You don't have it, and hence YOY doesn't look good. Thirdly, I said, let's use our common sense. Like again, coming back to the Virat, let's use our common sense. Are we seeing more houses being bought in India today than 5 years ago or less? And he said, mortgages to ho raha hai, home loans to log le rahe hain. And then I said, are we seeing more tax collections or less? He said, FM said at the budget that tax collections are growing more than the economy. So I said, that means that the informal painter is getting crushed. And I said, if you look at Asian Paints' volume growth over the last 3 years, it's pushing 13-14%. The long-term volume growth was 10-11%. They're actually growing faster now than they did ever before, because the economy is formalizing. They are the dominant player. It's formalizing in their favor. So let's ride with Asian Paints rather than losing sleep about is quarter kya hua ya last quarter kya hua. And this guy thankfully is persisting. But there will be other people who will say, "Arey, Asian Paints ka PE dekho and volume growth nahi aaya, let's sell the stock." And hopefully people like us will benefit from it. That's what I mean. When you look at noise, whether in cricket or in investing, you look at noise, not the signal, you end up transferring wealth to patient investors like us.
Oh, that's very, very interesting. But let me assure every listener and investor of ours, easier said than done. But then this is not the part of the end of the rainbow. This is real. It's not a mirage. And people who can practice patience will be headed to get that patience premium. So, well, Saurabh, as always, great pleasure. I think there's just one question that I can see from the audience. I'll take it. This is from Mr. Arindam Bhattacharjee. It's a question for you. He says, do you think the so-called chore companies have reduced in the past 10 to 20 years in India? I think the question is more on, is the improving governance climate?
So I think there's two parts to this question, right? One is, let's ask the easy part first, right? So I always love answering easy questions. Has the economic salience of chore companies reduced in India? 150% yes. So I'll give you some quantification on that, folks. The Indian stock market in the last 10 years has created 105 trillion rupees of wealth, right? So there are 10 years pehle Nifty dekho, aaj dekho, 105 trillion rupees of wealth created by the Indian stock market. 80% of that, so roughly 85 trillion, has come from 20 companies, right? If I show you the list of 20 companies, most of you on this group will say no more than 2 out of 20 are crony capitalists. 18 out of 20 are bona fide, hardworking Indian success story. Example, HDFC Bank, Kotak Bank, Infosys, TCS, Asian Paints, Bajaj Finance, Titan, right? And more like that. Now, these companies keep their mouths shut. Their promoters work hard. Their CEOs work hard. They don't buy cricket teams. They don't dance. They don't dance in page 3, on page 3 pictures and so on. So most client meetings, right? I ask people, do you know? And remember, our clients are typically moneyed people, intelligent people. I ask them, can anybody tell me the name of the CEO of, say, Titan? Right? Titan's compounded 320x in the last 20 years, more than any crony capitalist. And you'll be astonished. Hardly anybody in India knows the name of a man called C.K. Venkatraman. Right? Then I say, chalo, theek hai, let's look at the world's second largest IT services company. Does anybody know the name of the CEO of TCS? And hardly anybody, even in our client base, will know the name of Rajesh Gopinathan. Then I'll say, partly just to sort of calm myself down, I'll say, does anybody know the name of the CEO of Asian Paints? Asian Paints, remember, has created around 2,500, almost 3,000x in the last 40 years. And hardly anybody has heard of Amit Single. But you name a crony capitalist and everybody knows that, right? So the paradox of Indian life is the crony capitalist is able to convince everybody that somehow he is more relevant to the financial and economic system than actually he is, right? And the data unequivocally suggests that the impact, the relevance of the crony capitalist on the economy, on the stock market is actually far, far lower, close to being de minimis compared to the public perception of these people being central to life in India. Now let's come to the second point, right? Is the incidence in the stock market less? I would say yes. The India I came to, power, infrastructure, lending, real estate, metals, mining, was just crazy. It was bonkers. 2008 to 13 was bonkers for us. The number of corrupt companies I met, there's this insane extent of corruption, right? Whereas I would say a decade ago, 50, 60% would be dodgy. We're down now to 40%, which I don't think is that much higher than, say, developed world markets. I would say even developed markets, around a third of companies make their numbers up. I think we are at the 40% mark. But the good news, the really, really good news is the economic salience of this 40% is actually quite low. They will deliberately try to convince you that their economic salience is high, but the data suggests it isn't.
No, absolutely. So Saurabh, as usual, thanks a lot. I think it's a great pleasure talking to you.
Thank you very much, Srikanth. Thank you, everybody.
Thank you, and we'll stay in touch. Thanks.
Bye for now. Bye.